Great, and welcome everyone. After lunch break and hopefully also the poster session that you were able to join and discuss with others, I'm happy to start with the third session of the academic track, where we have prepared 4 speakers. The first one will be Bertram, who is an associate professor at the KDH, working on cross-disciplinary aspects of blockchain, which I think is very interesting, as I think the whole mode of operandi when it comes to blockchain, because blockchain by itself is very interdisciplinary. So it's interesting to see the perspective of how the technology that is provided by the underlying blockchain aspects can be also used for real world use cases. And with that, Bertram is looking to the aspects of quantitative analysis for various approaches. And he will be talking today regarding his focus of research, which is focusing in this case on the real estate tokens, based on the relationship with financial assets. With that, I would like to move over the stage to Bertram. Bertram, the stage is yours.
Yes, thank you so much. Thank you, Philip, and all your team colleagues for inviting, accepting my application and the ability to present today again a paper, because last year another paper of my co-author was presented about what is the driver of real estate tokens, the real estate facts in the background, so like location, as you would expect, because if you look at the buildings here in the city, 60% of the price of the value of a building is driven by the location itself, or is it more driven by the crypto factors? And it was a mixture. It is meantime published the other paper. Later for the question part. I'm doing since 2017-18, when Sweden had a pilot project about how we can transfer the real estate transaction from the normal notary book system with paper-based to electronic system. The pilot project was then finished in 18-19, but never really changed reality, so we still have the old traditional system in Sweden. But then I realized that US, very often, is much more advanced and just do it without waiting for legislation or changes in the system. So what I present today is based on US data. In the meantime, we have around 500-600 properties in the US, residential normal homes of people, which they rent them later, which are put on a blockchain, and then people around the world can buy it after they are whitelisted by the company. We have around 1 million transactions of these properties over the last 4 or 5 years. Today, I do not use transaction data itself. I aggregate them on a daily basis, so I reduce to 50,000 transactions. But still, for my research field, it's a huge data set. I have 4 years. It's as well good for me because I'm a quantitative researcher. I need data, historical data, to run my models. So now I have enough data to run my models, and I have another project as well about bonds, digital bonds, as yesterday very often was mentioned with Siemens as well. So I'm one of the authors. My author is my postdoc. She's the math person. I'm the finance guy. And just a few words on the motivation. Real estate sector is very often used as a real-world asset case, and it makes sense. Why? Because real estate investment is so big. And you as an individual, if you want to have as an investor, want to have a diversified portfolio, it means you should have 20 different properties in your portfolio. It is even better, different location, maybe different countries, then we look for, let's say, the last 100 years for opportunities how to do that. And my old senior colleagues say problem already solved, because we have REITs, real estate investment trusts in the US, we have funds in Europe, we have stock companies. All these vehicles solved the problem. So you are a fractional owner of a bigger pool of investors, people, and then the investment vehicle, special vehicle invest in the property. But still, it can take longer. You have fees, you have a lot of members involved. So the blockchain can still add on. It can increase the liquidity, in theory. So far, the liquidity, of course, of the real estate token market is slower than in comparison to the normal stock market. It can increase transparency, super important, because in comparison to the stock market, real estate market is extremely intransparent, and some old investors like it because the more inefficient a market is, the more profit can make if they are better informed than the others. And the portfolio diversification, it's not, I think that's a key aspect here. So it's super easy then, if you have a lot of tokenized properties. You can spend around the world, a different portfolio. You can spend with a small amount of money. Students can afford it. People in the developing global south can afford to invest around the world and around the globe in the real estate sector. So that's in theory why we have it. I have 3 papers published on this topic. 2 are open access, just contact me if you're interested. Talking about general pros and cons, business case perspective, and then the more quant-oriented papers as well. So when I wrote the last paper, which is not for the, which was, my focus was to inform the people in the industry. So it's published in one of the 2 top journals which are used from the financial sector in the industry part. The reviewer asked, yeah, interesting, but for investors, for institutional big investors, it is very important to know what is real estate token. Is it crypto? And then it is alternative investment for us? Or is it really real estate? Because then we can put it in our pool. We have, our board decides every year we want to have 50% in stocks around the world, we want to have 30% in bonds around the world, and maybe 20% in real estate. Or just with 1-2% alternative investments. And then that's super important to give the industry an understanding what happens to the real estate, the proper, the buildings, the bricks, if you put it on the blockchain. So this is the example how it works so far, and the paper, the figure of the other publication. So since we do not really have one single country, Marshall Islands maybe, which allows to put the property itself on a blockchain, we always work right now with the indirect way. So we put the property in a special purpose vehicle, a legal entity, and then the legal entity, so far, super traditional, boring. We have experience for 100 years how did we do that. But now we digitalize, we tokenize these legal entity. That's now possible for years. And that's what the US companies do, mostly, realty. And then the security token provider, realty, tokenize it, have then the initial public offering, or STO then, finance people would call it IPO, initial public offering. We have it on the first primary market, and then later people trade on the DEX, secondary market. That's the other paper which already published to analyze what drivers are here important and what drivers are here important by people trade on a daily basis in transactions. So it is a little bit the crypto sentiment on the market, but as well the financial market, but not so the location of the property itself. That's a surprise. So today and now, I focus more on the other question. What is really in a real estate token if you tokenize it? Is it more real estate or is it more crypto? That's Bitcoin and Ripple and Ether. And I use the methods which we use for years. It's regression in the end, regressions. But we have a big problem with regressions. If you have assets which are autocorrelated, so the last observation explains a lot what is going on today, then we cannot really run or put these in different of our models and forecast what happens tomorrow. And the industry like these models, these forecast models, because then they can decide, the forecast model says the price increase tomorrow, that's the reason why I buy more of these products, these assets. However, if you have data which are highly autocorrelated or not time series stationary, then our models does not work or give the wrong results. And Granger and Engel, who won the Nobel Prize 2003, were the pioneers in developing the cointegration model, allowing even non-stationary data to use in our models, and that's what I mostly do here. So I check the classical cointegration. It's okay if 2 time series do not move a line over time, but in the long run they have a specific equilibrium. And that's what we mostly expect on the financial market. So even if different companies, the oil, the gold, the commodities, properties, go in a different direction on the short run, 1, 2, 3 years, on the very long run, they go always up, hopefully. That's then the 10-year perspective, for example. And that's then what the industry is looking for, as well as the time of adjustment, the speed of adjustment. So how long does it take to have the difference between the movement between the different assets? And the more these assets move in a different direction, the more likely it is that we have bubbles in these assets. Then when Schiller comes in, Nobel Prize 1030, in explaining why we have asset price bubbles on the stock market or the real estate market as we had then around 15 years ago, mostly in the US. So I use these models because the industry, finance industry, are using this and helping to understand what is real estate tokens, assets in the real estate market or an asset on the crypto market. And if then these long-term equilibrium exist, then how long does it take to go back to the normal movement, and can you use it in your models? The more modern approach to the cointegration method is as well to assume that the cointegration perspective is not just stable over time, it can change, of course. The other big problem is if I present this to the classical macroeconomic people, they say long term. Long term means for me 50, 100 years. So of course I cannot present such a long time period, but still I have 50 months, and that's not so bad for my sector. So some words, I will use only US data. I use data from such simple residential homes, which are tokenized, around 1,000 whatever tokens for each property. Each property is an own investment vehicle, an own token pool one, and the price of one token is around $70 US. So again, everybody can afford it. It is spread over US, however, mostly located in Detroit as well. Warning that the data set, of course, is biased only US, mostly Detroit. What you can see here as well is major asset classes. So the industry is, the finance industry is interested how then the new asset class, real estate tokens, behave to the classical commodities, oil, gold, and mostly the stock market measured by the Dow Jones Industrial Average Index. The REITs, the other opportunity to invest in real estate, the classical one, or the crypto index of S&P, so mostly the Bitcoin, Ripple, and Ether. The Russell is a very broad index of stocks in the US, covering around 95% of all the market share. And then the real estate tokens is my own constructed index. So the own constructed index is based again around 50,000 observations. We do it on a monthly basis and construct the different indices which we need. The total return index, taking into account that you get dividends or rents on the stock/real estate market, and to see the different perspective of the investors. So what I mentioned, what we need is to test if you have stationary data. So because if it's not stationary, we have to fix the problem. And we find that we have a problem, and the cointegration approach will help us then to solve this problem. We find around 3 cointegration relationships, as I'll show in a few seconds. And the very interesting part here is as well then to see the speed of adjustment or the error correction term. And I will tell you a little bit more about that on the next slides. So we use the old back-end error correction model and the new co-intensity back-end, which was used by Kaiba in Chang for the crypto market as well, 2021, and we use it now for the real estate market as well to see how dynamic the cointegration relationship is over time. So here are the results. And the key fact is that we found 3 different linear combinations between the asset classes or 3 cointegration relationships. And it's a random process where you decide which asset class you want to fix. So we fix oil, gold, and the stock market, and see now how the real estate token market works in comparison to the classical real estate market. Is it more or less the same? No. The real estate tokens behave in first part in a different direction, that's important, and more to the crypto. So just following the first, you would say real estate tokens are more crypto than real estate. If you see the second, then you say, oh, real estate is, tokens are more the classical one, because both are negative than the crypto. But the second cointegration relationship is not so likely as the first one. And then in the third possibility, it is more or less as the previous one, but not so strong. So the first takeaway here is, it's not clear to say what it is, but most likely it is more the crypto than the real estate part. The second is then to think about the speed of adjustment, or the technical term would be error correction term. And that's interesting as well. How long does it take? Is it super fast or is it super slow? Fast means a high number. Positive means reverting to the same direction or in the opposite position. So what we see is REITs and tokens are very similar, but they're super slow. So they do not mean revert at a very fast time. And that's not so good for investors, because they want to have a higher speed of adjustments so that they can more and easier forecast what's going on tomorrow and invest or make more money out of that. And the same more or less applies if we use with two other possibilities. So to sum up, and to use then the more approach of the dynamic one, we see dynamic change, it increased over the last years, what we expected, and it's more or less stable right now. So I want to jump to the last slide, where we see then the dark side of how my approach, our research can be used, making money. So this is how investors are using then cointegration relationships. They use it for forecast models and make profit out of that. On a daily or monthly base, that's the first index. On a total base, that's the second figure here. So what you can see in the second figure, let's focus here, is on the right-hand side, your cumulative profit if you follow my approach. And then you start with zero, profit at the beginning. And what you see at the same time with the cointegration relationship over time, which increase over time, it helps you to make money. But you mostly reach then this high amount of profit if you have a stable cointegration relationship, which we had then over the last 2-3 years. So what we see is, to sum up now what I found for the first and now the second part is, yes, we have cointegration relationship between real estate tokens and the normal crypto real estate market. That's more with the crypto market and the real estate market. And yes, we have this cointegration relationship, which is stabilizing over the last 2 or 3 years, but it is still slow. But this stabilized cointegration relationship over the last years helps investors to make money by following this approach. Okay, thank you.